when you look at the GDP growth in America, it's very, very positive. It's pointing to about a 3 to 3.5% GDP growth rate. So the tailwinds of lower interest rates helps tech megatrend stocks. It helps growth stocks.
Hello, you're watching Proactive. I'm joined in studio today by Anthony Ginsberg. He's the CEO of Gins Global Index Fund. Anthony, good to see you in person for a change.
Great to be with you, Stephen. Thank you.
So let's start off with what's on everybody's lips at the moment. With AI and tech shares pulling back, are you seeing buying opportunity or are you tightening your risk?
Yeah, fair enough. Well, we're obviously running a tech megatrend product that's actually equally weighted, Stephen. So we do actually own AI. We actually think it's a buying opportunity right now. We think that AI is spreading its wings. It's still early days. And if you look at where AI is going to infiltrate more, increasingly it is into places like cybersecurity, cloud, robotics, even things like biotech. So it's still the early innings. I think some of these reports that came out in January and wobbled the market, it's more of a, I wouldn't say a falling off the cliff moment. I think it's more of a speed bump, frankly. So over the longer term, and we're looking 2-3 years out, I think it's hard to ignore the US. It's hard to ignore these AI players. But there will certainly be winners and losers too.
Anthony, how are you assessing valuation risk across AI, cloud, and blockchain holdings?
Yeah. So the average PE ratio for our tech megatrend fund is a lowly 21 times earnings, whereas NASDAQ, which is significantly overweight in AI and in the Mag 7, that's trading at around 34 times earnings. So if you actually extrapolate out the Mag 7, you actually get a tech valuation that's pretty attractive at 21 times earnings. The problem has been that you've got this very narrowness in the market with these Mag 7. Last year, the best performing Mag 7 actually was only number 75 out of the 500 S&P top performers. So I think it's had a very, very strong run. We see the market broadening out and actually changing. And for us, the most exciting opportunities are actually areas such as that are undervalued. Things like cybersecurity, cloud, social media, they really haven't run as hard. So those PE ratios are in the, as I say, the low 20s, and that's actually where, Stephen, we see more acquisition opportunity. Under the Trump administration, there's been a freeing up of M&A, the Federal Trade Commission is allowing more acquisitions. So that's the area where we see some of the AI guys are getting into it because they're obviously trading on very high multiples. But the exciting part for tech generally is this coalescing and conversions across multiple themes, even things like digital entertainment. As you know, Microsoft, a big cloud player, bought a very large digital gaming company some years ago. It was one of the largest, Activision at the time, $70 billion. So we do see more overlap over time. And I don't see tech as just an AI play. I really see it more of also a global play. One last thing I'll say is what's brought our PE ratios down significantly is the equal weighted approach where we have these sub-themes evenly distributed and every 6 months they're rebalanced. So last year, for example, blockchain, which was out of favor in previous years, actually was our best performer. And now this year, blockchain may not be doing so well, but defense tech has actually been a new area that we've seen significant pickup. So that's been actually our best holding sub-theme this year is defense tech.
I want to ask you about that because you recently added defense tech and also quantum computing. Are they helping buffer the volatility as intended?
Yes. So interestingly enough, quantum computing is still early days. So there are only 5 listings. We actually have 15 listings or holdings per each of our sub-themes. So we like to tell folks we've got 10 sub-themes in the megatrend ETF basket. But at the moment, 15 of them are for each of the top ones. So obviously AI, robotics, social media, they all have 15, but quantum only has 5, mind you. But quantum has become an importantly strategic area for the Pentagon, for the US government. So most of those holdings, the 5 we do have, are pure play quantum. They're not companies like an IBM that just happens to have a small area. But what we've seen in the US very quickly has been that the government and the White House particularly is making a strategic imperative. So Rigetti Computing, IonQ, they all had a very, very good run last year. It's come off a little, but there's been profit taking in the last month or two. And what's actually buffered us for the moment has actually been defense tech. So since December, defense tech is up over 25%. It's been quite a strong gain. And again, defense tech is benefiting from the externalizing of government contracts to third-party contractors in Silicon Valley and whatnot, things like drone technology and other areas. I think the Pentagon, the CIA, others in the US government, State Department areas have recognized that they've got to actually bring in businesses to help, basically be a ballast for the defense industry and no longer just rely on the 4 or 5 big prime contractors.
Anthony, blockchain's cooled recently. Do you expect consolidation or a slowdown?
Yeah, blockchain is an interesting one because when I tell people that actually it slowed down, they're surprised to hear that blockchain was actually our best performer last year. It did 33% last year. Year to date in 2026, it's up about 6.3%. So blockchain is actually completely decoupled from Bitcoin. So although Bitcoin, we all know, has sort of fallen off a bit of a cliff recently, the blockchain part is actually putting on my old accountancy habits, so the rather boring part of, because it's not crypto. We're not buying any Ether or any blockchain, I should say, cryptography at all. It's all the back office ledgers, digital administration side of it. So it's actually held up reasonably well. Part of the reason it's held up is the fact that we're equally weighting 15 holdings. I'll just say one last quick thing about when you talk about blockchain and some of these other areas. Because there's a global essence to a lot of what's going on in tech megatrends, excluding non-US holdings, I think it's really hurt a lot of other tech funds. What we've actually found being a ballast and really helping reduce the volatility, the fact is that we've got Chinese holdings of around 12%, Japan's about 7.5%, 8%. Asia as a total is now almost a quarter of our fund. And that has certainly helped us, Stephen, in the last year and a half. We were actually up almost 20% last year, partly because of the emerging market nature. I'll just say one thing, the robotics leaders are not American. So examples where you find the Yanks not being so strong and having not been born in America, I could perhaps say this. You've got areas such as robotics being leaders in South Korea, Japanese players, and then we thought it was rather short-sighted to ignore the whole Chinese ecosystem. So when you look at Baidu and you look at Alibaba, Alipay, BYD, electric vehicles, many of these guys are leaders in their fields, and it was short-sighted to exclude it. So we've always included China as part of our global mix.
So with Netflix pulling out of the race, it looks like Paramount and Warner are going to be joining up. Do you see more consolidation in the sector?
Yes. So since I'm based in California, I can tell you the rumblings from Hollywood will continue. There's a lot of cost cutting going on in Hollywood. There's a lot of nervousness about these new platforms. Obviously, the streaming platforms from HBO to Amazon Prime to Netflix are certainly changing the way we consume in the States. I can tell you that a lot of the movie industry folks are very worried that the movie houses themselves, the cinemas, are really going out of business in many ways. So that they'll retain a couple of prime locations in places like Beverly Hills, but the average cinema is really, really struggling. So I wouldn't be surprised if Netflix comes back into the mix, maybe not with Warner Brothers, but perhaps with one of the other studios down the line. I think they just realized, as you saw, they got a pop of almost 10% overnight in their share price. So it wasn't a particularly positive deal for Netflix shareholders. So there's been a bit of a rebound there, yeah.
Okay, maybe just ending with a kind of a macro theme. I mean, with the macro tailwinds like easing inflation, how do you see the market moving forward for the rest of the year?
Now, that's a very interesting question. We actually are quite positive that despite all the rumblings on tariffs and some of Trump's antics, when you look at the GDP growth in America, it's very, very positive. It's pointing to about a 3 to 3.5% GDP growth rate. So the tailwinds of lower interest rates helps tech megatrend stocks. It helps growth stocks. We also see the tax and fiscal stimulus coming through in America over the next 12 to 18 months. This big, beautiful bill that Trump passed last year is only now finally coming through. And not that we agree with everything, but the reality is the average American is getting almost a $2,000 boost to their income. And also capital expenditures from the big companies, including AI. There are significant attractive write-offs allowing these data centers to be built. So I wouldn't be surprised if you see this massive tailwind of about 3.5% GDP growth. The other thing, Stephen, is the lack of red tape. Under President Biden and the former administration, they did put the kibosh on a lot of M&A deals. Goldman Sachs just hired the largest cohort of new managing directors in about 5 years. So it tells you something of the nature that there are going to be more IPOs. And the truth is, a lot of the smaller mid-cap tech stocks are ripe for the picking in terms of being acquisition targets. And a lot of the stuff was blocked under the previous administrations. So whether you like it or not, I would say the deregulation, the lack of red tape, and just the fact that you've got more business-friendly folks at the Commerce Department, at the Federal Trade Commission, the SEC, that those are all tailwinds. So we remain fairly optimistic. I'll say one last thing is that the weaker US dollar, interestingly enough, is not a negative. It actually is a positive for a number of the large export earners. It helps boost the earnings per share for a lot of the larger American multinationals. So all in all, we're happy with the global exposure and not too dissatisfied with a slightly weaker dollar.
Thanks as always for your insights. Great seeing you.
Thank you, Stephen. Thank you.
That's Anthony Ginsberg, the CEO of Gins Global Index Fund.